Good afternoon, everyone, and thank you for joining Richey May at today's webinar, Common Audit Issues. Just a few housekeeping notes before we start. All participants will be placed on mute during the presentations, but during the Q&A session, feel free to unmute yourself to ask questions. You can also submit them through the chat function in the webinar app. This webinar is being recorded. The recording and slide deck will be sent out within a few days. CPE credit is available to attendees who answer all 4 poll questions scattered throughout the presentation. If you are looking to get CPE, you must answer all 4 poll questions to be eligible. If you qualify, the CPE certificates will be sent to you via email within the next few weeks. There will be a survey that appears on your screen at the end of this webinar. Your feedback is extremely important to us, and we want to provide you with as much value as possible through these webinars. If you would take just a few minutes to fill that out, we would greatly appreciate it. For those of you who may not be familiar with Richey May, we were founded almost 40 years ago to focus exclusively on the needs of the mortgage banking industry. This singular focus from our experts enables us to help lenders accomplish their goals. Our experts believe in the forward progress and success of the industry and dedicate much of their time to teaching through webinars like this and building others through the MBA School of Mortgage Banking and at other industry conferences and associations. And with that, I'd like to turn it over to today's presenters. Richard and Kelly, take it away.
Thanks, Felicia. Hello, everyone. My name is Richard. I'm a senior audit manager here. I'm excited to be able to present our material today.
Great, thanks, Richard. Yeah, and I am Kelly Earhart. I'm an audit manager in the mortgage banking audit department, and likewise, just happy to be here and excited to do this presentation.
Great, thanks, Kelly. Okay, we're going to start off with the agenda for today's session. We're going to talk a little bit about the distinguishing between loans held for sale and loans held for investment, and then spend a good chunk of time on accounting for business combinations and goodwill. And then we're going to save some time at the end for a Q&A session, so if you have any questions throughout the presentation, please feel free to put those in the chat and we'll be monitoring those for the end. All right, the first area we're going to talk about is distinguishing between loans held for sale, aged loans held for sale, and loans held for investment. Real quick, going to go over some definitions between each item. So mortgage loans held for sale, those are loans that the lenders originated or purchased, and the intent is to sell those on the secondary market. When we get into loans held for investment, we're going to discuss how the delineation between the types of loans is really the intent of management. So loans held for sale are typically recorded in the balance sheet at fair value, and then the changes are reported in the gain on sale of mortgage loans held for sale on the statement of operations. One thing that we noted somewhat frequently in this past busy season was that there were some clients that had origination fees and discount points included in the fair value of their loans held for sale. Since those are received at loan funding, they should be recognized and recorded as revenue at the time of loan funding and not included in the fair value of the loans held for sale. However, it is appropriate to factor those items in your interest rate lock commitment fair value, since those are a piece of the value of the loan when the loan funds. Saw this most common when clients would change their hedge providers. Sometimes in that change, there's just a little bit of a change in the process and what items are included in the fair value. So it's just we encourage you to make sure you're having discussions with your hedge provider to make sure you know which items are being factored into the fair value of your loans held for sale. All right, next one I'll talk about is mortgage loans held for investment. And really the key difference here is that the intent is there's the intent and the ability on behalf of the company to hold a loan for the foreseeable future. And then they're going to be recorded on the balance sheet at either fair value or amortized cost. So you have the option to record either, and it kind of depends on the origination of that loan, which I'll talk about here in a little bit as well, as to which category that loan is more appropriate to be recorded in. All right, and the last one is mortgage loans held for sale aged. Really, these are basically the same as loans, mortgage loans held for sale. It's just that, for various reasons, those have been is greater than 90 days since that loan has funded. The real issue that we see most commonly on these is that these loans still need to have a fair value associated with them. So, if you have a loan that, there's a defect in it and you're going to sell it on the scratch and dent market, we encourage you to get an S&D bid for that loan. Or if you haven't sent a specific loan out for a scratch and dent bid, then we recommend using most recent scratch and dent bids and then kind of aggregating into an average and then using that as a benchmark to value any loans that you haven't actually sent out for a bid. On occasion too, you can have a loan that's aged 90 days, but maybe there's a repooling for Ginnie Mae purchase or something like that. So you still could have a fair value that's positive. But the key item there is that just because a loan is aged past 90 days doesn't mean it should be recorded at par. It still needs to have that associated fair value with it. Okay, and with that, we're going to do our first CPE question.
So our first question is, how comfortable are you with the delineation of LHFS, loans held for investment, and aged LHFS? I'm sure you can say that better than I did, Richard.
Sorry about that. Yeah, it's a tongue twister.
And again, just to keep in mind, you need to answer all 4 poll questions so we can send you that CPE. And answers are coming in. Probably need to give it another 30 seconds or so to make sure you all get this the way you would like. I'm sure there's just a few more people who are trying to make their answers right now, and in just about 5 seconds or so, if you're out there, just answer the question. We want to make sure you get it. Okay, with that, I am going to close it and share those results. So Richard, 8% said new to me, 37% said somewhat comfortable. We have 50% saying I am comfortable, and 5% out there says very familiar. I'll lead the topic next time.
Nice. We're going to take your names down to lead the topic for next time. Awesome. For those of you that are somewhat comfortable, us here at Richey May, we're always happy to talk through these items with you. So, feel free to reach out to your contact and we'd be happy to have a discussion. Okay. So continuing on, just have a quick chart here on really the difference between aged loans held for sale versus loans held for investment. What we see on occasion is that some companies, well, once a loan hits that 90 days age, they just automatically move that to a loan held for investment, and that's not necessarily the best course of action. Really, the key difference is, and it's underlined on the slide, is that aged loans held for sale, there's still the intent to sell that loan in the secondary market, either through a scratch and dent bid, or if there's an issue with the loan, you're able to cure that, so then you can sell it to another secondary investor, possibly repooling the loan. Whereas the loans held for investment, you have the intent, and then you have the ability, you've got the cash flow necessary to hold that loan for the foreseeable future. A couple other items to consider in the loans held for investment, if they're should stratify those loans between performing and non-performing. And if you have non-performing loans, this is where you could potentially need to record an allowance for credit losses. Last year that was a big one on the CECL new guidance. So we encourage you to have a process in place to determine if you have a non-performing loan, what that potential loss could be. And then we also encourage to have policies in place to properly identify which bucket these loans belong in between the loans held for sale, aged loans held for sale, and the loans held for investment. And the loans held for investment can come from different sources. If you potentially repurchase a loan, then that, because the loan has an issue from an investor, you repurchase it back. You might just record that loan at cost and then amortize it as any payments come in. Other sources are, aged loans that you're not comfortable with the scratch and dent market right now, so you decide as a company that you're going to hold that loan for the foreseeable future until things improve, and you want to sell that loan. So that loan would be held as well. Okay, I kind of hit on a little bit in the last slide, but transferring loans from loans held for sale to loans held for investment, really the key item that we saw on occasion during this past busy season is that, you know, most loans held for sale are held at fair value. When you transfer that loans held for sale to the loans held for investment, it's going to need to remain at fair value on the balance sheet. ASC 825 discusses that once a fair value election is elected for an asset, that election is irrevocable. So you can't take an asset at fair value from loans held for sale and then start recording it at cost when you move it to the loans held for investment. And then kind of a real quick, once you sell aged loans held for sale and loans held for investment, there's a couple things to consider. Most importantly, probably from if you sell a loan that's in the loans held for investment bucket, if it had been a non-performing loan and you had recorded an allowance for credit losses under CECL and you end up selling that loan, then you'll want to reverse out the allowance you recorded for that specific loan and then record any associated gain or loss with the sale of that loan. For aged loans held for sale, is really basically going to be the same treatment as your general loans held for sale, just going to record that gain or loss in the gain on sale of mortgage loans on the statement of operations. So, you know, again, this sometimes is a little bit of a complex area to make sure you can identify the correct bucket, but if you have any questions, you know, feel free to reach out to us at Richey May. And with that, I'm going to pass over to Kelly, who's going to talk about some notes receivable construction loans.
Okay, great. Thanks, Richard. So yes, next we're gonna move into those construction loans. So we've been seeing a trend of more of our clients getting into offering this product. So we just want to spend some time talking about accounting for this. So with the next slide. Okay, so for construction loans, these can be presented at either lower of cost or market or fair value. Again, if that fair value election's made, that is revocable, just as Richard was mentioning. Most often we see clients present these at lower cost or market, primarily because it can be difficult to get a reasonable fair value estimate on these loans. But if you do have it at lower cost or market, you need to consider potentially a current expected credit losses and that allowance. So something to keep in mind with these loans. Now, if you do have it at low com, you don't have the fair value election, then you would need to be deferring these origination costs on the construction loans. So as the popularity and volume of these loans grow, we're anticipating that the net amount that may not be currently be deferred, it could become more of a material issue. So that's why we want to touch on it a little bit. So those net origination fee income less the direct cost should be deferred until either the loan is sold if it's a loan held for sale, or it would be amortized if it is a loan held for investment. So just that net amount, you would defer it. If it's at low com, it would be incorrect to recognize those at the time that that loan is funded. So let's go to the next slide. Okay, so some examples of the origination fee income would include prepaid interest, discount points, and then fees related to the origination activity, which could include underwriting, processing, application fees, etc. And then the direct costs would include incremental direct costs incurred with transactions with third parties for that loan, preparing and processing loan documents, closing the transaction, or commissions or other incentive pay, as long as it directly relates to that loan and would not have otherwise been paid. So the net amount of this income and direct costs is what you would need to defer, again, if these loans are presented at lower cost or market. Okay, next slide. So as far as management's responsibility, if you originate or if you plan to originate construction loans, you want to consider whether they're going to be presented at low com or fair value. If it is at low com, just review those associated origination fee income and direct costs and ensure that net amount is being deferred, again, either until the loan is sold, if those loans are held for sale, or that those deferred costs are amortized through the life of the investment if it is held for investment. And the key thing is just to not recognize those immediately. The other item to consider is the analysis for current expected credit losses. We can say just from our client base, we haven't been seeing very many losses that weren't just temporary. So in other words, we haven't seen a lot of significant allowances recorded for construction loans, but you would still want to consider, just based on your portfolio, maybe the geographic area where these are being constructed. For instance, if it's in a natural disaster location, are there potential losses that you could incur and that you would be responsible for that you would maybe need to consider in terms of recording an allowance? But then on the flip side, if you're not presenting these at LOCOM, if you're going to elect that fair value option, you just want to determine how you're going to obtain that reasonable fair value estimate. Okay, let's move to the next slide. All right, so we're going to do our second poll question, which is how many construction loans do you have on your balance sheet? Either none, 1 to 15, 16 to 50, or more than 50.
So again, we want to make sure as many folks as possible get CPE. If you haven't answered this question yet, and I can tell a lot of you haven't, please do so we can get you that CPE. Okay, we're gonna get a good chunk in there, but there's still some that haven't answered. If I could get everyone in there, that would be great. Okay, just about 10 more seconds. Oh, here comes a few more, thank you. Okay, looks like everybody is in. I'm gonna go ahead and close the poll and share the results. So we have 47% saying none. 24% have 1 to 15, 11% have 16 to 50, and 18% have 51 plus. So quite a good number.
Okay, great. Thanks, Felicia. Yeah, so for the good portion of you that have none or maybe just a small amount, these would just be things to consider if this is a product that you're looking at offering. Or on the other hand, if you have a handful of these, maybe a double check depending on how you're presenting, again, whether it's LOCOM or fair value, double check that you've got that origination fee piece correct. And we'd be happy, of course, to talk through any of that on a call with you. So feel free to reach out to us if you have any additional questions that we could help sort out for you. So, okay, let's move to the next slide. All right, so next we're going to talk about business combinations, goodwill, and contingent consideration. First, we're gonna touch on business combinations and kind of the difference between a business combination and an asset acquisition. If you have a transaction and the legal document says asset acquisition, that doesn't necessarily mean it would classify as one in accordance with GAAP. So we're gonna go through the considerations that need to be considered in terms of making sure you're recording that under the appropriate guidance. And a key thing that I'll try to highlight throughout is that making sure that you document in a memo everything that you're evaluating, considering, and concluding when it comes to any of these items. So for business combinations, that essentially means that you're acquiring one or more businesses. If you have a business combination, then you might have goodwill that's being recorded. And you could even have consolidation of your financial statements. If it's an asset acquisition, then you're just acquiring an asset or group of assets, and it's not considered a business. So the definition of a business is the key kind of factor here that would determine what's more appropriate. And if your transaction doesn't really fall into either of these two, there's a chance it could just be startup costs that would be expense in the period incurred. So you just want to make sure you have a really thorough understanding of your transaction. And again, you can reach out to your Richey May team for any assistance if needed. So let's move to the next slide. Okay, so first there's an initial screen test. That's just kind of a quick question that might automatically classify it as an asset acquisition, that then you wouldn't need to go any further into the business combination considerations. So this question is substantially all of the fair value of the gross assets acquired concentrated in a single asset or group of similar assets? So the answer to that is yes, it's an asset acquisition, and you don't need to, again, consider any of the other business combination evaluations or, yeah, it's kind of just classified for you just with this simple question. And it might be worth noting when it says substantially all, that's typically interpreted to mean 90% or more. Okay, next slide. All right, so if you answered that question no, then you would need to continue on to the framework that we'll talk about now. So this guidance comes from ASC 805. The simplified definition of a business is that it's an integrated set of activities and assets that provides a return in the form of dividends, lower costs, or other economic benefits. And so the guidance provides these three elements that you would need to consider in determining if what you're acquiring is a business and that you can apply that business combination accounting guidance to your transaction. So those three elements are the inputs, processes, and outputs, as you can see on the slide. Inputs would just be economic resources that contribute to creating outputs when processes are applied to it. Some examples could include long-lived assets, maybe intangible assets or right-of-use assets, intellectual property, access to materials or rights, and even employees. Some examples of processes could be strategic management processes, operational processes, resource management processes, which might be documented. A key factor for processes is that it could include the intellectual capacity of an organized workforce that have the necessary skills and experience to perform processes that, when applied to inputs, create outputs. So I'll give an example in the next slide of that. But the key thing here is that it contributes to creating outputs. So certain functions like accounting, billing, payroll, and other administrative functions are typically not processes that contribute to creating outputs or that create outputs themselves. So those wouldn't be considered processes that make a business in the terms that are defined here for this criteria. And then the last item is that the outputs, which would just be goods or services to customers, investment income like dividends or interest, or other revenues. So if you have all of these in what is acquired, then you have a business. But there could be scenarios where what you acquired doesn't have outputs itself, but can contribute to the creation of outputs, and that might still meet the business combination guidance. So we'll look at that next with the next slide. So if what you acquire does not have outputs, as long as it still has inputs and any of the following three processes listed that contribute to creating outputs, you would still have a business combination and can apply that guidance. So those three things are employees or a contractual workforce that are critical to continue producing outputs, a process that cannot be replaced without significant cost or delay in production, and a process that is considered unique or scarce. So if you have one of those three processes, you have inputs, and it's contributing to creating outputs, you could still have a business combination. So a lot of that criteria and wording comes from the guidance and can kind of be applied to any business type, but maybe to touch on some examples you might see in the mortgage banking industry. When you think of inputs, maybe for intellectual property, you could think about a customized LOS. When you think of processes, that could be processing, underwriting, or originating that's contributing to creating that mortgage loan, which would be most likely the output, as that generates revenue for the company once that's sold. And kind of a key thing that could contribute to having a business combination is acquiring that organized workforce, employees who can perform those processes. So processors, underwriters, loan originators. So if you have a lot of those things and it's either creating the outputs or significantly contributing to creating the outputs, then you may have a business combination and can apply that guidance. But the key thing is to just really understand your transaction, read your purchase agreement, and know exactly what you acquired and what you did not acquire through the transaction so that you can apply this criteria correctly to your transaction. So let's go to the next slide. We have a couple slides where we'll just go through some examples of items and how you would account for them. So for transaction costs, if it is a business combination, then you would expense those as incurred and not consider that as part of the consideration transferred. Versus if it is an asset acquisition, then those direct transaction costs are going to be capitalized as a component of the cost of assets acquired. Okay, next slide. All right, if you have contingent consideration, which we will talk through a little bit more in more detail to come, but at a high level, if you have it and it is a business combination, you're going to record that at fair value at the date of acquisition. And then depending on if it's classified as a liability or equity, those subsequent changes would be remeasured every year and potentially recognized through earnings until that contingency is settled. Versus if it's an asset acquisition, as long as it's probable and reasonably estimable, if that's the case, that initial amount would be recorded on the acquisition date as part of the initial costs of the assets acquired, and any subsequent changes would be just an adjustment to that cost basis. All right, next slide. Okay, and then the last example we'll touch on is goodwill. So in a business combination, you would recognize goodwill, which is that difference between the consideration transferred and the fair value of what you're obtaining. Versus an asset acquisition, you would not recognize goodwill. So when you think about the criteria we just talked about for considering if it's a business combination or an asset acquisition, for an instance, if you did that initial screen test and you concluded it's all concentrated to one group of assets, so it's an asset acquisition, you shouldn't have any goodwill that you would record as part of that transaction. Instead, any excess consideration that is transferred and exceeds the fair value of what you obtain, that excess would just be allocated to your identifiable assets based on their relative fair values, instead of being recorded as a goodwill asset. Okay, let's go to the next slide. So next we're going to talk about goodwill and more importantly, the impairment analysis. But first, let's talk about the calculation of goodwill. So like I mentioned, it's that difference between the consideration given and then the fair value of the assets and liabilities that you took with the acquisition. So that plug essentially, as long as your consideration exceeds what you're obtaining, is goodwill. If it's the other way, you would never have negative goodwill, so it'd be a bargain gain on purchase. So a key thing in this definition is that what you're acquiring, those assets and liabilities, need to be recorded at fair value. And fair value of those assets and liabilities may not be what the book value was that the seller had it at. So you may need to consider how you're going to obtain the fair value of what you've acquired. And potentially consider using a valuation specialist if that's needed. If not, you would just need to be sure to document how you've determined the fair value of what you've acquired so that you can show that what you recorded is correct and at that fair value at that acquisition date. Okay, next slide. So assuming you have a business combination, you have goodwill that's recorded, there are some accounting alternatives available for private companies that can be elected. And then going forward, you also want to consider the impairment analysis of that goodwill. So as we think about goodwill, that asset really represents the acquired future economic benefits of that's going to bring to the company. So if you think high level about a goodwill impairment analysis, you might want to ask some questions like, is what was acquired that resulted in the goodwill still intact? Have economic factors impacted its value? Is it still bringing economic benefit to the company, or is it still expected to in the future? So those could be some questions to ask, and maybe might indicate there's a triggering event. Goodwill could be impaired, and we might need to consider, recording that on the books, but we'll get into that analysis a little bit more. And then as a quick reminder, goodwill is an unacceptable asset. So for any HUD or Ginnie Mae eligibility requirements, you would be backing out that goodwill asset from your net worth. And you'll see that as well in the financial statements too, and those supplemental schedules at the end. Great. Okay, next slide. All right, so first we'll talk about the private company alternative elections that are available. The first one is you can choose to amortize goodwill. It would be amortized over 10 years or less if you can demonstrate another useful life is more appropriate, but it would never be more than 10 years. And that amortization period would begin on a straight line basis from the period that it's adopted, and that amortization expense would hit your P&L. The next item is the level of testing for that impairment analysis. You can choose to either assess it at the entity-wide level or the reporting unit level. If you didn't elect this private company alternative, you would have to do it at the reporting unit level, which then requires that you take everything that was acquired, those assets, liabilities, and as well as that the goodwill that you calculated as part of that transaction, all of that you need to allocate out to your different reporting units and then do that goodwill impairment analysis on each reporting unit. So that can be a little bit more time consuming. So as a private company, you could elect to instead do entity-wide and kind of simplify that a little bit. The next one is the frequency of impairment testing. If you don't elect the alternative, or if you're a public company, that impairment testing, it's trigger-based assessment, but it would be at any point in the year if a triggering event occurs that you would need to assess your goodwill for potential impairment, versus for a private company, if you make the election, it is only at the end of a reporting period, whether interim or annual, that you would need to assess if there has been a triggering event and then do the impairment analysis. It's no longer required that you have to do the analysis at least annually. However, you still need to consider triggering events, and we'll get into some of those examples, but just to maybe clear the air a little bit, as your audit team, based on the mortgage industry currently, we would consider the economic factors there a triggering event. And so when it comes time for the audit, we would be anticipating, if you have goodwill recorded, that an impairment analysis is going to be performed. So if you have questions about that, again, feel free to reach out to your Richey May team, but that's kind of just our expectation as we consider the rest of this year going into year end. Okay, and then the last election is the allocation of impairment. If you didn't elect the private company alternative, or if you were public, you have to allocate the impairment to each reporting unit that you would have had to perform the analysis on, versus if you elect the private company alternative, then you may not have done it at the reporting unit level, and instead you would just allocate the impairment charge to the separate amortizable units of goodwill, if that is applicable to your company. And again, with this election, with any elections, it's always good to document that in a memo. the items such as the level you're performing your impairment analysis, whether it's entity-wide or reporting unit, is one of the items that would be disclosed in your financial statements. So it's just always good to have it documented so that we know, if we're preparing your financial statements for you, making sure we're representing the correct elections that the company made. Okay, next slide. All right, so when it comes to actually performing the impairment analysis, it's called a single step test, but there is a step 0. So really it's first a qualitative assessment and then a quantitative assessment. The qualitative assessment is asking, is the fair value of the reporting unit or entity more likely than not less than its carrying amount? And then if you've asked that question and considered all of the different factors and determined that yes, it is more likely that the fair value is less than the carrying amount, then you go to step 1 and actually quantify it, put numbers to it, and calculate what that impairment amount is. Let's go to the next slide and we'll talk about the different factors to consider in the qualitative assessment. So these also overlap with triggering events. So at a high level, if one of these kind of rings a bell that your company is experiencing, this may indicate there's a triggering event and you would need to do that impairment analysis. If you're public or if you didn't elect the private company alternative, you need to do it kind of as soon as you identify the triggering event versus at the end of your reporting period if you elected the private company alternative. Okay, so just to go through these, the first one, macroeconomic conditions, that could include deterioration in the general economic conditions, limitations on accessing capital, fluctuations in foreign exchange rates, or other developments in equity and credit markets. And then the next one, industry and market considerations. Now you're kind of drilling down, not just overall macroeconomic, but drilling down into, for instance, the mortgage banking industry specifically. So that could include deteriorations in the environment in which an entity operates, increased competitive environment, a decline in dependent market multiples or metrics, change in the market for an entity's product or services, or regulatory or political developments. The next one, cost factors. That would be increases in raw materials, labors, or other costs that would have a negative effect on earnings and cash flows. The next one, overall financial performance. That would be a negative or declining cash flow, a decline in actual or planned revenue or earnings compared to budget or maybe prior periods. The next one, other relevant entity-specific events. That could be changes in management, key personnel, strategy, or customers. Could also include if there's contemplation of bankruptcy or litigation. Next, events affecting a reporting unit. That could be if there's a change in the composition or carrying amount of a reporting unit's net assets, or if it's more likely than not that that reporting unit is going to be sold or disposed of, or at least a portion of it will. Any of that would obviously impact that reporting unit and could be indicative that there might be some impairment associated with that reporting unit. And then the last one, sustained decrease in share price if applicable. Okay, let's go to the next slide. So that was all of the qualitative assessment criteria that's defined in the guidance as examples of what to look at. So if you had performed that analysis and then determined there is impairment, you would be, let's look at an example of, putting numbers to it and determining that impairment amount. So in this example, during 2024, this company had a significant decline in production, earnings, and cash flows. And so they determined it was a triggering event. They performed that qualitative assessment, determined it was more likely than not that the fair value was less than the carrying amount. So then they put numbers to it. So the carrying value they said was 1,000. The fair value was only 700. So if you didn't know the Goodwill amount, that alone is indicating $300 of impairment. However, the goodwill recorded is only $200, and you can only record impairment of goodwill up to the amount that is on the books. You could never have negative goodwill, so the impairment of goodwill in this case would be the $200. Okay, next slide. This will wrap up the goodwill aspect of my section. So just some common audit issues, business combinations versus asset acquisitions, making sure you're considering that criteria to know how to appropriately account for your transaction, and remembering that if it is an asset acquisition, there should be no goodwill that is recorded. If you do have a business combination, making sure those assets and liabilities are valued at fair value, and maybe considering if you need a specialist to ensure that that's recorded accurately. If you have goodwill, and now you need to consider impairment, remembering those triggering events. Some common ones, or maybe most relevant that we might see across our client base, could include economic uncertainty, significant changes in key personnel or customers, significant litigation against the company, or declining financial performance. And then again, with all of the analysis and elections made, any evaluation of management for these different factors, documenting all of that in memos so that you kind of have the proof of the work you did. And it's something that we would ask for during the audit to show what management determined and make sure that we believe that's also reasonable based on the facts and circumstances, and just as support for your financials as well. So great, let's move on to the next slide, which is our third poll question. And this question is, have you performed a goodwill impairment analysis? Either yes, no, I don't have goodwill, no, I have goodwill but have not performed in the past, or no, I've recently obtained goodwill and will need to perform for the first time this year.
Okay, thank you, Kelly. And we just want to make sure that everybody gets CPs. So we still are waiting for. Okay, just a few more. Okay, closing. The majority of folks said they don't have goodwill. So yes was 33%. No was 64%. No, I have goodwill but have not performed in the past was just 3%. And nobody has, no, I've recently obtained goodwill and will need to perform.
Okay, great. Well, that sounds good. Sounds like most people who have goodwill have performance analysis, or you just don't have goodwill. But if this is, if there's going to be an acquisition in your future and it might meet that business combination criteria and result in some goodwill, these would be things you'd want to keep in mind. But again, at Richey, we'd be happy to sit on a call with you to help talk through any of the concerns you may have or questions around that. Okay, so let's move on. The last section from this portion that I'll go over is contingent considerations, which generally represents an obligation of the acquirer to transfer additional assets or equity to the selling shareholders if future conditions occur or are met. And it's often used to enable the buyer and the seller to agree on terms of an acquisition, even though maybe the ultimate value of the business has not been determined, so that that consideration can fluctuate with that, potentially the performance metrics that need to be hit. So this guidance comes from ASC 805. You would recognize and measure your contingent consideration at fair value as of the acquisition date if you meet that business combination criteria. and if that obligation to pay would either be classified as a liability or it could be classified as shareholders' equity if it's equity interests. Okay, next slide. All right, so this just gives you that same definition that I essentially already mentioned, but just if those specific events occur or conditions are met, that additional consideration will be given. The key thing we're going to cover today is making sure that that distinction between a contingent consideration versus compensation cost is understood based on the specifics of maybe your transaction that you have, and understanding that it is accounted for differently. If it's a transaction cost, that would just be a whole separate transaction. If it's compensation costs, sorry, it would be a whole separate transaction accounted for, not part of the consideration given in that initial journal entry recorded for that acquisition. All right, next slide. So if your contingent consideration is a liability, that means there's going to be future consideration transferred. You would again, value that fair value initially and then remeasure at each reporting date. Same thing if it's an asset. However, if it is a contingent asset, that's a little more rare. It can be kind of a tricky, making sure that that's recorded correctly can be a little tricky. So if you think that you have a contingent asset in your transaction, we would encourage you to reach out to your Richey May team just to make sure that we're on the same page too. And again, there's no audit issues that might come up during field work at the end of the year. And then it could have equity classification. And if it is equity and classified that way, then it is not remeasured after the acquisition date. All right, let's go to the next slide. All right, so contingent consideration versus compensation costs. Again, we want to kind of touch on that these should be accounted for differently depending on what criteria it falls under, if it's truly additional contingent consideration versus if it should really be accounted for as compensation costs. One scenario that maybe is kind of the easiest quick identifier is that if those post-acquisition, contingent consideration payments are forfeited upon termination of employment, then it is considered compensation costs and should not be accounted for as contingent consideration. So if that employment hinges whether or not you would pay that additional contingent payment, then that factor of it being dependent on continued employment would classify it as compensation costs. But ASC 805 provides a number of indicators. So let's go to the next slide and we'll look at those. Okay, so these 8 items are the different indicators that depending on the circumstances would classify either those payments as contingent consideration or compensation costs. Let's go, there's 8 listed here, but let's go to the next slide. We have it kind of displayed as a table so you can easily identify based on the specifics what it would fall under. So that first one is kind of the main one I hit on already. If those payments are forfeited upon employment termination, that would classify it as compensation costs, versus if that employment does not affect those payments, it wouldn't be, it would indicate that it is contingent consideration. Similarly, the duration of employment, if that employment, the required period is less than the contingent payment period, then that might indicate it is contingent consideration, versus if that required employment period for those contingent payments extends longer than the contingent payment period, then it would be classified as compensation costs. Let's go to the next slide. And some of these, we've got the examples on the slide, so I won't go through all of these in detail, but maybe just some key items to mention. If there's a difference, if there's multiple sellers and some of them become employees and some of them don't, if there's differences in how those two groups of sellers are treated, that might indicate whether it's contingent consideration or compensation costs. Let's go to the next slide. And that could be in terms of actual payments made or numbers of shares owned by those two groups. Linkage to the valuation, that would be, if your valuation is how that contingent payment is based upon, then it might indicate it's contingent consideration. Or if those contingent payments are based on a percentage of earnings, that might suggest a profit sharing agreement, and then it would be indicative of compensation costs. Then next slide. And then that's the same thing here for determining consideration. Again, if it's percentage of earnings, could be compensation costs, but there could be other specifics in your agreement that would just need to be considered. So non-compete, executory contracts, consulting contracts, and all of their related income tax treatment could indicate one way or another. So again, just another scenario where you just really want to understand your contract and what you're acquiring and how those payments are being, what they're being based on for the contingency to be met. Okay, let's go to the next slide, but based on time, we won't go through it in detail. In essence, it just is that the employment dictated whether payments would be made. And so since the employee, if they had not remained an employee for those 2 years, they would have forfeited the payments. So in this scenario, it would be considered compensation costs instead of contingent consideration. Okay, and then the next slide, we'll wrap this up with the common audit issues here. So this would be remembering to remeasure that consideration, determining whether your consideration is really contingent consideration or compensation costs, and then making sure that value of that contingent liability is at fair value. And I'll pass it back over to Richard to go through the additional focus areas.
Awesome. Thank you, Kelly. That was some great information in that. We appreciate it. Okay, in our few minutes left, we have a few additional quick focus areas. These are just going to be a few quick hitter topics. The first one we'll touch on real quick is some branch receivables. So based on the industry, the conditions in the industry last year, we saw a few of these come up. And it's just a reminder that branch receivables are really generally not permitted by the Department of Labor, as they're a little bit tough to, and as well as through GAAP procedures, they're a little bit tough to justify based on expenses incurred by the company to record a receivable for those expenses. So on to the next one, MSR valuations. Real quick on this one, if you have your MSRs at fair value on the balance sheet, when you get an updated valuation, that tends to be a large gain or loss, of non-cash gain or loss is going to go to your statement of operations. So have a policy in place for management to review that the key inputs are within a tolerable range. And Richey May has some tools to help with that through Richey May Select and a few other tools. So please reach out to your Richey May team if you'd like some additional input on that. And this will be in the slide deck, but just a friendly reminder to consider CECL with regard with servicing advanced receivables. And then on the next one, gonna toss it back to Kelly real quick for one other item, and then we'll have our last CPE question.
Okay, great. Yes, this last item is home equity conversion mortgage-backed securities. So just as a note, if you're brokering these and selling them like regular loans for sale, nothing too different there. You just would not have an IRLC on these loans because you cannot lock them with the borrower ahead of time. But if you're considering going into securitizing these, there's quite a few differences in your financial statements and disclosures. So you would have gross up, loans held for investment and secured borrowings, and a number of disclosures. So we would want to just make sure that we're on the same page going into year end if this is something you're interested in getting into. So let's go to the next slide and the poll question, which is, how much HECM loan production do you expect to have this year? None, less than 10 million, between 10 and 200 million, or more than 200 million.
And again, everyone, we want to hold this poll question open to make sure that you get the last question needed for your CPE. I can see that we still need a bunch more people who are looking for CPE, but they haven't voted yet. If you could take just a moment and answer this, and then in just a few seconds, I will share the results. Just waiting for a couple more. Make sure you get your answer in so we can send that CPE. Okay, looks like everyone is here. I'm going to close this and share the results, Kelly. So 51% said no, none, sorry. 32% said less than 10 million. 11% said between 10 to 200 million, and then 5% said more than 200 million.
Okay, great. Yeah, so about half of you sounds like don't have any, and then the other half have some. So again, just if you have some, hopefully you're not recording any IRLC derivative liability asset for those HECM loans. And then if you were thinking about securitizing them, talk to your team, your audit team, because that does have quite a few changes to your financials that we want to make sure we're ahead of. Okay, so next slide. This will be in the slide deck, but just for the sake of time, we won't go through this. But if any of these stand out as items that you would want to talk through, make sure to, again, reach out to your audit team, and we'd be happy to go over any of these with you. And then, yeah, the next slide is just recapping what we talked through. But based on time, we want to make sure we have time for Q&A. So let's skip right to the Q&A session.
Sure, we do have a couple questions that came in, Kelly, about goodwill impairment analysis. So the first one is, the acquired assets from a previous acquisition are essentially gone, but the company is still performing and profitable. Do I need to do a goodwill impairment analysis?
Okay, yes, good question. So yes, if really whatever in essence you acquired that had brought about that goodwill is no longer intact in the company, it's not bringing economic benefits to that company, that would indicate that that goodwill is likely impaired. So you would want to perform a goodwill impairment analysis. And again, it seems likely based on that scenario that it could be impaired.
With a couple minutes left, I also did get another one about the same subject. So do I need to perform a goodwill impairment analysis if I am amortizing goodwill?
Okay, yes. If you are amortizing goodwill, so you're a private company and you elected that private company alternative election, you would still need to perform a goodwill impairment analysis. If all things were, the same, no conditions had changed, theoretically, that analysis would get easier each year as you kind of chip away at your goodwill balance. So it becomes theoretically less and less likely that that fair value would be greater than your carrying amount, but you would still need to perform that.
I have one last,
yeah.
I have one last question that just came in that I'd like to throw out there. How are loans held for sale aged and loans held for investment as non-current or current assets? And Carrie, if I did not ask that correctly, go ahead and unmute your mic. Okay, go ahead and answer it because
yes, I think typically we're going to have those on the current assets portion of the balance sheet, because the loans, especially if they're in the aged loans held for sale, because the intent there is to still sell those, as soon as you can. And if for Loans held for investment, again, that intent is just for the foreseeable future. And so that could be 6 months, it could be a year and a half. So that's, since it's a little bit ambiguous, we typically include those in the current assets section.
Okay, Carrie, and we can also follow up with you directly to make sure that I asked the question correctly. Okay, I think that's it for the questions right now. I'd like to thank everyone for being with us today. We so appreciate having the honor to serve you. And if you have any additional questions, please reach out to your Richey May team or to the follow-up that you'll receive in the next couple of days. Thank you all again and have a great afternoon.
Thanks, everyone.
Yep, thank you.